Welcome to The Explainer. Let's just dive right into this, because we are looking at a number today that, honestly, it absolutely defies human comprehension. The United States is currently drowning in debt to the tune of $39 trillion. It's this massive, mind-boggling scale that, most of us just kind of glaze over when we hear it on the news. You've probably been told that this staggering figure is totally fine, that it's backed by the full faith and credit of the government, and that we should all just trust the process. But today, we're going to unpack the unseen, globally engineered system that actually holds this giant illusion together. It's literally a system that forces the entire planet to keep using the dollar just to survive. And as you'll see, that system is really starting to crack.
$39 trillion. I mean, just look at all those zeros. If we break that down, it equates to roughly $114,000 for every single American alive today. This isn't just some abstract macroeconomic talking point. This is a heavy, invisible backpack of debt assigned to you, your neighbors, your kids. When a country owes this kind of money, the rules of normal finance start to bend, and you have to rely on these complex mechanics that the average citizen never votes for, and let's be real, probably never even thinks about.
To put that into perspective, if you spent $1 million every single day since the birth of Christ, you still wouldn't even reach $1 trillion. Actually, scratch that. It wouldn't even be 2% of what America owes today. It's wild. So here's the immediate paradox, right? With debt this astronomical, why hasn't the US dollar completely collapsed? Why aren't everyday groceries impossibly expensive for us right now? Well, the answer is that the rest of the world is actively absorbing our inflation. Central banks in Tokyo, Frankfurt, New Delhi, and Seoul are soaking up trillions of American dollars each year, basically just to keep their own lights on.
Section 1. The secret handshake. Blueprint of the machine.
If the dollar is the operating system that 180 national currencies run on, appearing in nearly 90% of all foreign exchange transactions on Earth, we have to ask, what forces them to use it? Well, the blueprint of this colossal machine points to one central mechanism: the global oil market. Valued at approximately $2.5 trillion per year, oil completely dwarfs the global market value of gold, iron ore, copper, aluminum, nickel, zinc, lead, tin, cobalt, and lithium combined. It is the single largest traded good in human history. And the linchpin to American economic survival is this: for 50 years, the vast majority of that oil had to be purchased in American dollars. Whether you're a Japanese company buying Saudi oil or an Indian power plant importing from Iraq, you've got to buy dollars first. That creates an absolutely insatiable, mandatory demand for US currency. To understand how we got here, we've got to trace this timeline back a bit. In 1944 at Bretton Woods, the world agreed to peg their currencies to the dollar, which was pegged to real gold. But by the late 1960s, massive US spending on the Vietnam War and the space race meant America was printing dollars way faster than it had gold. Countries like France noticed, and they started demanding actual gold for their paper dollars. The US gold reserves drained so fast that in 1971, President Nixon shocked the world by closing the gold window entirely. The dollar was suddenly backed by nothing but good vibes. Inflation spiked. Then came the 1973 oil embargo, which quadrupled gas prices and crippled the economy. The dollar desperately needed a new anchor to survive. And then, enter Henry Kissinger in 1974.
So the crucial point here is this brilliant, almost absurdly simple three-step solution Kissinger brokered with Saudi Arabia. Step 1. Every country needs oil. Step 2. Saudi Arabia agrees to sell its oil exclusively in US dollars, meaning countries must buy dollars to get energy. Step 3. Because countries now need these huge stockpiles of dollars, they hold them by investing in US Treasury bonds. In exchange, the US guaranteed Saudi Arabia's security. It was the ultimate secret handshake. America effectively installed a toll booth on the global economy. Every time a foreign government bought American debt to hold their dollars, they were financing Washington's federal government, allowing the US to build highways and win the Cold War on the world's dime.
Section 2. Bypassing the toll booth. For half a century, that toll booth held strong, but the foundation is shifting. You see, the United States is actually the largest oil producer on Earth right now, meaning we don't necessarily need to buy oil in dollars ourselves, but we desperately need the rest of the world to do so. The problem is, China is now Saudi Arabia's single largest customer, importing nearly 2 million barrels a day. That's enough to fill 127 Olympic-sized swimming pools every 24 hours. And China has decided it wants to build a road right around America's toll booth. To understand their game plan, we have to look at the current plumbing of global finance, SWIFT. SWIFT is the messaging system banks use to process about $5 trillion a day. Because it operates under Western oversight, the US has enormous influence over it. In February 2022, when Russia invaded Ukraine, the G7 kicked Russian banks out of SWIFT and froze approximately $300 billion in Russia's Western reserves. Impartially speaking, if you are a non-Western nation watching this happen, you immediately ask a very uncomfortable question. What happens if we're next? That single action totally spooked countries into accelerating their search for an alternative.
And here is the bypass road they built, M-Bridge. Launched out of Switzerland's Bank for International Settlements, M-Bridge lets countries move money directly between each other using their own central bank's digital currencies. It entirely avoids Western intermediaries, detours, and most critically, US oversight. It went live in 2024, and by late 2025, it had successfully processed over 4,000 transactions worth $55 billion. Now, while that's tiny compared to SWIFT, M-Bridge wasn't designed to ask the West's permission. It was designed to avoid it. America's ability to just cut any country off from the global economy suddenly doesn't look so unavoidable.
Section 3. The slow bleed. The structural unraveling of this 50-year-old habit isn't some overnight crash. It's more like a slow bleed. There was this rumor floating around in June 2024 that a formal petrodollar treaty had expired. The truth is, there was never a binding legal contract to begin with. It was always just a structural agreement, a mutual dependency. And that dependency is undeniably unraveling, one non-dollar transaction at a time. Economist Zoltan Pozsar coined this transition Bretton Woods Third. He argues that the world is shifting from inside money, which are just paper claims on governments, like US Treasury bonds, to outside money, physical assets like gold and oil. As Pozsar puts it, commodities are collateral, and collateral is money. When the G7 froze Russia's reserves, it permanently changed the global calculus. It signaled to every non-Western central bank that paper, dollar-denominated assets could simply be confiscated. So what are they doing? They're moving toward physical assets they can actually control.
The reality of this slow bleed is right here in the numbers. In the 1970s, the US dollar held a commanding 85% share of global foreign exchange reserves. Today, that has dropped to roughly 58%. Now, 58% is still clearly a majority. It's nothing to balk at. But here is why this matters so much. That 58% is the lowest point in 2 decades for the dollar's global dominance. The trend line is undeniably pointing downward, and it's doing so consistently.
Section 4. The localized impact, or the warning. It's really easy to look at global currency markets and think, well, that doesn't affect me. But let's bring this massive macroeconomic shift straight to your wallet. Because if the world stops absorbing our debt, the bill lands squarely on us. Here is the exact domino effect. The US government currently pays over $1 trillion a year just in interest on its debt. That's more than the defense and education budgets combined. This doesn't crush us right now because foreign governments constantly buy US treasuries. But if fewer dollars are needed globally for oil, fewer US treasuries are purchased. When demand for bonds drops, bond prices quickly fall. When bond prices fall, yields rise. And when treasury yields rise, domestic mortgage rates track them almost exactly. So the absolutely crucial point is what happens to your daily life. Look at this recent historical example. Between 2021 and 2023, mortgage rates moved from 2.65% to 7.79%. That exact jump means the monthly payment on a standard $400,000 loan increased by almost $1,300. That is literally the difference between keeping your home and losing it. It puts car payments and family vacations in severe jeopardy. Now imagine that happening not because the Federal Reserve is deliberately raising rates to fight inflation, but simply because foreign central banks stop needing our currency. The Fed can't force other countries to keep absorbing American debt.
Section 5. The final domino. We really have to zoom out and look at the historical precedent here, because it paints a very clear picture of what our ultimate takeaway should be. Every single global reserve currency in human history has eventually lost that status. The Roman denarius, the Dutch guilder, the British pound sterling. Reserve currencies are kind of like bad software. Everyone knows a better option probably exists, but switching the whole system is just a massive pain. So you just keep running the old version until you absolutely can't anymore. When Britain lost its reserve status after 1945, there was no apocalyptic explosion. Instead, the pound just slowly became less relevant. British citizens were forced to absorb the hidden costs through decades of inflation and a steadily declining standard of living. That is the exact template we are seeing for the US dollar today as global demand slowly erodes. And the hard data proves that this erosion is actively underway. The BRICS bloc now represents almost 36% of global GDP and a massive 44% of global oil production, and they are actively utilizing non-dollar systems. China's alternative to SWIFT, called CIPS, already connects 109 countries. India is out there buying Russian oil in yuan and rupees. Brazil and China ditched the dollar entirely in their bilateral trade. Saudi Arabia is utilizing M-Bridge while maintaining strategic ambiguity by keeping its options open. The toll booth is being routed around right before our eyes.
So I want to leave you with this stark question to end our explainer today. The $39 trillion illusion only works because the rest of the world keeps needing our dollars. The real threat isn't whether China builds a perfect alternative system. It's this. What happens when the world decides the alternative they've built is simply good enough? Because when the world starts moving those trillions somewhere else, it won't stay contained to currency markets. It will snap our system into a new reality, spilling directly into your interest rates, your asset prices, and your everyday life. Thank you so much for joining me on this explainer, and stay curious out there.